Good evening, students. Good evening, students, friends. I welcome you, all of you, to this session on audit insights. And today's topic is audit report. And we have with us CA N. Jayendran, who has got 35 years experience, in assurance and handling income tax matters. So, students, such a huge experience and even I am very excited that we will learn a lot from Sir. So, Sir, I welcome you to the session, Sir.
Thank you. Thank you.
Yes, sir.
Should I start? Yeah.
Yes, sir. You can start, sir.
So, students, today I'm going to speak on standards on auditing bearing numbers 700, 705, and 706. I will be speaking on 701 on Saturday along with my presentation on Caro. So let's begin with 700. What exactly is 700 and why do we need a standard on audit reports? The 700 standard primarily deals with issuance of audit report. SA 700, 701 is on key audit matters. 705 is when you want to modify your report. And 706 is when you want to make an emphasis of matter or carry a paragraph on other matters. These standards are applicable for all periods beginning on or after April 1, 2018. इसके पहले भी there were standards, but there has been some modification in the standards from April 1, 2018. I'll briefly touch upon those modifications. So just to recap, SA 700 is forming an opinion reporting on financial statement to be used only in the case of unmodified opinion. I'll stop here for a minute to say what is unmodified. When you don't modify your opinion, the opinion is called unmodified. And when you modify, there can be three types of modification. One modification can be qualification. One modification can be an adverse opinion. And one modification can be a disclaimer of opinion. So colloquially, we all call modification as qualification, but qualification is a subset of modification and not a form in itself. It's not a class in itself. It's a subset of a class called modification of audit opinion. Now, when you want to modify your opinion, you have to follow this procedure stated in SA 705, which deals with modification to the opinion in the independent auditor's opinion to be used only in the case of modified opinion. SA 706 deals with emphasis of matter paragraph and other matter paragraph in the independent auditor's report to be used only if you want to make an emphasis of matter or you want to deal with other matters. SA 701, communicating key audit matters in the independent auditor's report. This is a new standard which has come into effect from last 3 years, applies primarily to listed companies. And I will deal with this on Saturday. This is just to cover the complete brief on 700 series. There is another standard which is 720, which deals with other information. If I have time on Saturday, I will touch upon that. SA 700 revised, forming an opinion and reporting on financial statements. What was the biggest change? The flow of the reporting has been changed substantially from the earlier SA 700. The new standard is applicable for audits of all financial statements for accounting period beginning on or after April 1, 2018. So today, if you want to issue a report, you have to mandatorily follow SA 700. And why do we need a standard for audit opinion is because if I was to draft an audit report and you were to draft an audit report and if we were given the freedom to draft it in our own style and manner, then to the reader, it will be difficult for him to understand what exactly are we trying to say. That is why what is called a boilerplate reporting is what is enumerated by SA 700 so that the reader or the investor can know exactly what to look for, where to look for. And that is the primary purpose of having a boilerplate audit report. A boilerplate is something where the format is fixed and you just have to paste it if it is applicable to you. This applies only to a complete set of general purpose financial statements. So there is something called a special purpose financial statement for which there's a separate standard of reporting, which is SA 800. A general purpose financial statement is those financial statement which is addressed to the shareholders. They comply substantially with the financial reporting framework. You have to follow the formats of the balance sheet and the profit and loss account. You have to follow the column which is enumerated in the format of the balance sheet, profit and loss account. And those are called general purpose financial statement. This is what is normally signed for a limited company where you upload to MCA. Apart from this, there could be special purpose financial statement where you make a financial statement for a December end or a September end. You do only for a division. You do only for maybe some other purpose. You want to do a merger. You do a financial statement for that purpose. Those are special purpose financial statements, and those are driven by a standard SA 800 audit reports and special purpose financial statements. Although the form and content can be used for all audit reports, including the special purpose audit report, the SA 700 applies only to general purpose financial statement. The flow of the report can be the same even for SA 800 format of reporting, but 700 per se applies only to general purpose financial statements. Audit opinion on general purpose financial statements. What is the purpose of having SA 700? To form an opinion on the financial statement based on evaluation of the conclusion drawn from the audit evidence obtained. So once you complete your audit, you follow the other standards. You do your audit, you do your materiality, you do your vouching, you do your management representation, and now is the time when you have to issue your opinion on the financial statements. You have to follow SA 700, and that is the main purpose of SA 700, to dictate a format to form an opinion on the financial statements. The audit report is a document through which the auditor expresses his opinion on the financial statement after concluding his audit of the financial statements. Therefore, it is the audit report which is the ultimate deliverable in an audit engagement for our audit of financial statements. It is this document which is our main and primary objective. And if I can say, this is this document for which we are paid for. Our job is to issue audit report and not to make the financial statements. Financial statement is the responsibility of the management. Our responsibility is only to form an opinion on the financial statement prepared by the management. So all of us over the years spend more time on correcting and finalizing financial statements and spend little time on the audit report, because we generally follow what is called APLY as per last year. We pick up last year's opinion, change the years, we change this without actually spending time to see whether what we are saying is what is a fact. Therefore, students, you have to be very clear, because this is your ultimate deliverable. You need to follow this. This is what is for which you have been appointed. This is for which you are getting paid for. And this is our primary responsibility. Of course, to issue this document, you have to follow various procedures dictated by the other standards on audit and accounting. It's not that this is it is not the goal. There is a complete path to reach the goal, and you have to follow the entire audit procedures, including obtaining evidence, including obtaining and forming an opinion, forming skepticism, having professional judgment. All that comes into play, but the end is issuance of this audit opinion. This standard culminates the entire audit process, and the process ends with the issuance of this report. Therefore, issuance of report after forming an opinion enhances the dependability on the financial statements. Anybody can prepare financial statements, and somebody needs to say that these financial statements reflect true and fair view. And students, we are the only privileged profession to be entitled to issue audit opinions. Anybody and everybody can do tax, anybody and everybody can do GST compliances, but an audit can be done only by chartered accountants, and this is the sole area where we are entitled to do it, and therefore we need to make sure that we do our job to the best of our ability. In order that the reader does not have to search for the opinion paragraph in the report, the first reporting paragraph is the opinion paragraph. So when you look at the audit report, the first paragraph will tell you, if it just says opinion, that means it's an unmodified opinion. If it says qualified opinion, that means it's a modified opinion, and the type of modification is qualification. If it says an adverse opinion, then it's again a modification. The type of opinion talks about an adverse opinion. And if it's a disclaimer of opinion, that means the auditor has disclaimed, has refused to issue an opinion, and therefore that is called a disclaimer of opinion. So whether it is an unmodified opinion or a modified opinion, your first paragraph will always be the opinion paragraph. So you don't have to search what is the auditor trying to say. That's why the format has been changed, where the first paragraph is the opinion paragraph. Earlier, before 2018, you had a basis for opinion early, and then you gave the opinion. Now you begin with an opinion, and then you give the basis for your opinion. So the basis of opinion would also be applicable to an unmodified opinion, to a modified opinion. So basis opinion now follows the opinion paragraph. The auditor's responsibility is now a more detailed paragraph detailing in a more specific manner the responsibility of the auditor. So earlier, before 2018, the basis of opinion paragraph was the auditor's responsibility paragraph was very small. Now there's an elaborate and SA 700 appendix details what you need to mention, and any good audit report that you pick up, you will find that the same language has been used, because that details in a boilerplate format the auditor's responsibility. And it is now necessary that you need to enumerate your responsibility clearly to the reader. He must know what exactly is your responsibility. When does an auditor form a clean, unmodified opinion? When can you issue an unmodified opinion, or what is called a clean opinion? The auditor can form an unmodified opinion if and only if the following are satisfied in all material respects. The financial statements are prepared in all material respects in accordance with the applicable financial reporting framework, including qualitative aspects of entities' accounting policies, possible bias in management judgment. The auditor has obtained reasonable assurance about whether the financial statements are free of material misstatement due to fraud or error. This is what is called SAAE, sufficient appropriate audit evidence. You must remember SAAE, it is used everywhere, which is sufficient appropriate audit evidence. So your evidence should be sufficient and appropriate to justify your opinion. When uncorrected misstatements are not material, see, it is possible that some errors or some mistakes they do not correct. For example, they have debited conveyance to traveling account of an amount of rupees 50,000. 50,000 conveyance has been debited to traveling. The balance sheet size or the turnover of the company is 100 crores. The profit is, say, 20 crores. In 20 crores, this 50,000 is not material for you to qualify an opinion. And that is why materiality is important. So when the uncorrected mistake, so this correction, they said, abhi jane do, main nahi correct karta hu. So this uncorrected mistake, whether it is material or not, is important. And if it is material in aggregate or individually, then only you will need to modify your opinion. Otherwise, you can still continue to give an unmodified opinion. So to form a clean, unmodified opinion, you need to ensure that the requirement of the reporting framework, that is the accounting standard, have been materially complied with. Disclosing the accounting policy selected and applied, and consistency and appropriate of those policies. So 1 year you will have WDV method of depreciation. Next year you'll have straight line method of depreciation. Next year you'll have a WDV method of depreciation. That will not give a true and fair view, because the comparability gets affected. So to ensure comparability and consistency for the reader to understand how do you perform. So if you look at a financial statement in itself, it will not disclose the progress or deterioration of the financial position of the company unless it is compared with the comparative figures. And that is the reason why everywhere two set of reports or two columns are required, current and previous, unless it's the first year of accounting. Reasonable estimates are used by the management. Information presented in relevant, reliable, comparable, and understandable format. Disclosures are adequate to users to understand the effects of material transactions. And terminology used is appropriate. Even the usage of terminology should be appropriate. And if these conditions are satisfied, then you can form a clean, unmodified opinion. What is the auditor is not able to comply with the foregoing requirement, that one of these items is not complied with, and therefore he is unable to tick off all the requirements to issue an unmodified opinion. If an auditor is unable to satisfy the requirement of issuing a clean report or an unmodified opinion, he shall refrain from issuing an unmodified opinion. Do not get forced to issue an unmodified opinion if what I've mentioned in the prior two slides are not satisfied. You must refrain from issuing an unmodified opinion. You must not refrain from issuing an opinion. You have to issue an opinion, because if you are an auditor of a listed company, SEBI prohibits you from resigning unless you issue an opinion. You cannot resign from an audit engagement having accepted if you have finished the earlier 3 quarters. So if you have given a limited review report for 3 quarters, you have to finish your full year, issue your opinion, and then only you can resign. You cannot resign otherwise. Same is the case with institute. Institute also has a guidance on circumstances when you can resign. So professional preoccupation is no more a very easy task to say that now I'm busy, I can't do the audit. He shall then evaluate how to modify his opinion, for which the relevant standards and reporting requirements covered in 705. So you cannot issue an unmodified opinion as per 700. So what are the next steps? You need to evaluate, how will I modify the report? Do I need to qualify? Do I need to give an adverse opinion, or do I disclaim my opinion? Such reports shall be called modified opinion and are dealt with later in my presentation. The flow of the audit report as per revised SA 700 for a clean opinion. The first one is title. Title will be independent auditor's report. The addressee, you have to address the report to somebody. The addressee of the report is going to be the members of the company, because you're appointed by the shareholders to conduct the audit of the financial statements of the company. So your report is to be addressed to the shareholders. The next is the auditor's opinion, and then the basis for opinion. This basis of opinion is to be given even for an unmodified opinion. Then if there is a going concern issue, then you will report on the going concern. If there's a key audit matter, you'll report on the key audit matter. If there's an emphasis of matter, then you report on the emphasis of matter. Then comes the management responsibility for financial statements. So what exactly is management responsibility for financial statements is again enumerated in the appendix. By and large, you must cover what is stated in the appendix, because appendix is a guidance and most of us follow the appendix unless what is stated in the appendix is not strictly applicable to your client or to that company to which you're issuing an opinion, which is seldom the case. Next is to give the auditor's responsibility for the audit of financial statements. What exactly audit of financial statements? Then the other information. What is the other information? I'll touch upon briefly. When you have formed an opinion on the financial statements, the management has made some representations to you, has given some basis, has given you some information. Now, in their director's report or in the management discuss analysis, what they are stating is different from what has been the basis on which you concluded the audit, then you have an obligation to take it to those charged with governance that what you have stated that is wrong, different from what I've read or what you have told me when I was doing an audit. So either you modify that to confirm that what you told me is the correct position. And in case that is the correct position, then you may have to modify your audit opinion, because there is inconsistency with the rationale which was explained to you when you were doing the audit and the statement made by them elsewhere in the annual report. So therefore, there's an obligation of the auditor to read the director's report, management discussion and analysis, any other information, which is even the figures in the director's report cannot be different with what has been shared in the financial statement. So you need to tick off those items also. Then there is reporting on other legal and regulatory framework. Now, this is your requirement under 143(3) of the Companies Act. Then the signature block, and then the place and date of signing. I will stop my presentation over here for a second, and I will show you a sample audit report, which is of, say, Infosys.
Sir,
Yes.
so we have received a query. A student
Huh.
is asking that in the slide now you have written that for basis for opinion, that for unmodified opinion also, there what should be the basis for the unmodified opinion?
Yeah, I'm showing that in the audit report.
Okay.
So this is Infosys audit report. I hope it is visible to everybody. So what did I say? The title is Independent Auditor's Report. To who is the addressee? To the members of Infosys Limited. What is the name of the report? Report on the audit of standalone financial statements. The first paragraph that I said is opinion. What are they saying? We have audited the financial statement of Infosys for the so-and-so year, statement of P&L, cash flow, and the summary of material accounting policy and other information. And this is the opinion, in our opinion, and to the best of our information, according to the explanation given to us, the aforesaid standalone financial statement give the information required by the Companies Act in the manner so required and given true and fair view in conformity with the Indian accounting standard prescribed under 133 of the Act, Ind AS, and other accounting principles generally accepted in India of what? The state of affairs of the company as of 31st March 24, the profit, the total comprehensive income, the changes in equity, and the cash flow for the year under that day. Now, to form this opinion, what was the basis? We conducted an audit on the standard financial statement in accordance with standards on auditing specified under 143(10). So now the standards on auditing have legal recognition because section 143 within bracket 10 of the Companies Act states that the audit shall be conducted as per the standards on auditing, and standards on auditing is that which is issued by the Institute of Chartered Accountants of India. They are primarily in line with international standards on auditing, excepting for SA 600, over which there is some debate going on at this juncture, whether we need to align our SA 600 with the international SA 600 or not. That matter is going on, and in some time that will get cleared. So here you're saying our responsibility under those standards are further described in the auditor's responsibility for the audit of the standalone financial statement section of our report. We are independent of the company in accordance with the Code of Ethics issued by the Institute of Chartered Accountants of India, together with ethical requirements that are relevant to our audit of the standalone financial statement under the provisions of the Act and the rules made thereunder. And we have fulfilled our other ethical responsibility in accordance with these requirements and the ICI Code of Ethics. We believe that the audit evidence obtained by us, this is important, we believe that the audit evidence obtained by us is sufficient and appropriate to form a basis for our audit opinion on the standalone financial statements. So this is our basis or opinion. So this is the paragraph which states that how did I give my opinion? Now let's assume for a second, let me first go through 705 and then I'll open the 705 sample of a qualified opinion, where I will have to say that the audit evidence obtained is not sufficient and appropriate to provide a basis for my qualified opinion. And that's the reason why I've qualified the opinion. So this basis of opinion is necessary even for a unmodified opinion. When it is unmodified, you don't write unmodified opinion, just opinion means it's unmodified. A qualified opinion will be called a qualified opinion. Adverse opinion will be called adverse opinion. And when you disclaim an opinion, you will say disclaimer of opinion. Then there is key audit matters. We will deal with this later on. This is the other information that I said. The company's board of directors is responsible for the other information. The other information includes MDA, board report, annexure to board report, business responsibility and sustainability report, corporate governance, shareholders, and does not include the standalone financial statement because I've given a separate opinion on that. Our opinion, the standard finance does not cover the other information, and we do not express any form of assurance conclusion thereon. In connection with our audit of the standard financial statement, our responsibility to read the other information. As I said, SA 720 mandates that the auditor should read the other information, and whether the other information is materially inconsistent with the standalone financial statement or our knowledge obtained during the course of our audit or otherwise appears to be materially misstated. So either the other information is misstated or the information given to me on the basis of which I formed an opinion is incorrect, which means that I might have to again modify my opinion. If based on the work we have performed, we conclude that there is a material misstatement of this other information, we are required to report that fact. Now, since there is no inconsistency, we have nothing to report in this regard. So this is the other information. Then this is a detailed paragraph on the responsibility of management, that they are responsible to make the financial statements. They are responsible for the financial statement. Our responsibility is only to give an audit opinion. In a lighter vein, when the first time this reporting requirement came in one of the AGMs, one shareholder got up and तो फिर वो लोग करते हैं कि हम इनको इतना फीस क्यों पे करते हैं, ऑडिटर को इतना फीस क्यों पे करते हैं, अगर वो लोग बोलते हैं कि हम ये सब नहीं करते हैं. So then the audit committee chairman explained that we prepare the financial statements and the responsibility of auditors is only to give an audit opinion. So our responsibility is only to give an audit opinion and not to prepare the financial statements. If financial statement is not prepared, we may advise them to correct those financial statements so that we don't have to modify our report. But if they do not correct those financial statements, then we need to modify the report. Then this is the auditor's responsibility. Earlier, before 2018, the auditor's responsibility paragraph was very limited, very small. Now the auditor's responsibility is pretty large, where most audit opinion, including the one that I issue, contain almost the same information, where detail, if you look at SA 700 appendix, it is gray marked in the appendix. You will find that they have detailed how it has to be done, and you pick up out of 195 of them will have the same language, verbatim. This details exactly what is our responsibility. I'm not going through this whole thing because that in the interest of time, but as students, you must read this to understand. This will also tell you what exactly you're required to do and what is your responsibility. After this is a report on other matters where I said under 143, there is no emphasis of matter in this case. In the case of Infosys, there is no going concern issue. That's why those paragraphs do not appear. But the other paragraphs are mandated. At the bottom, you have the signature block and the place where you have signed it and the date when you have signed it. So these are the essential matters of the audit report. And as I said, if I was to draft it differently from Mr. Sanjeev Pilgaonkar, a reader will not know what am I trying to say. So that is the reason why all of us have almost the same language, so that the reader of the report understand where to look for a particular information, where can possibly different lines be there. That is the reason why the format and form is enumerated by SA 700, and we have to follow the format and form. And in case you are unable to give a clean report, then please move to SA 705, which will detail the paragraphs as to how to modify your report. So I explained to you the title, address, auditor's opinion, basis, going concern, key audit matters. In the case of Infosys, these are not there. That is the reason why you don't find these paragraphs.
सर
Yes.
सर श्रेया स्टूडेंट पूछ रही है सर
हाँ.
कि जो आपने कहा कि ऑडिटर की रिस्पॉन्सिबिलिटी थी, ये आप स्टूडेंट से एक बार पढ़ लेना जो आपने बोला है.
Yes.
तो उसका एक ओवरव्यू आप बता सकते हो उसमें क्या होता है सर?
Yeah, okay. I can run through the paragraph. Yes. So a reader should know our objective are to obtain reasonable assurance. See, nobody can give absolute assurance. Audit does not require to give an absolute assurance. Absolute assurance is a misnomer, is a misconception. It's not possible to give absolute assurance. A reasonable assurance is sufficiently large assurance that the standalone financial statements are, as a whole, are free from material misstatements, whether due to error or fraud, and to issue an auditor's report that includes our opinion. This is our responsibility. Reasonable assurance is a high level of assurance, but is not a guarantee that an audit conducted according to standard will always detect a material misstatement when it exists. Therefore, I said to give an absolute assurance is impossible. That is why the standards don't expect you to give an absolute assurance. What they expect you to give is a reasonable assurance. How can misstatement happen? Can happen because of error or fraud and are considered material if individually or in aggregate they could reasonably be expected to influence the economic decisions of user taken on the basis of these standalone financial statements. So as an audit, what do? We exercise professional judgment and maintain professional skepticism. Students, याद रखो, शक करना हमारा पेशा है. If you're an auditor, शक करना आपका पेशा है. To doubt is your profession. Does not mean that you have to be a stickler and doubt everything, but you must have what is called a professional judgment and professional skepticism to ensure that what has been told to you corroborates with what is the other information that you obtain during the course of your audit. We also identify and assess the risk of material misstatement, obtain an understanding of internal financial controls, evaluate the appropriateness of accounting policy, conclude on the appropriateness of the management use of the going concern basis of accounting, and whether material uncertainty exists relating to condition that may doubt the company's ability. For example, if I have a lot of losses and I have a huge liability, I may not be able to continue. Somebody may take me to NCLT and the company may be shut or company may be wound off. So therefore, you are supposed to also evaluate whether the going concern basis of accounting is appropriate or not. Our conclusion based on the audit evidence obtained up to the date of audit report, however, future events or condition may cause the company to cease to continue the going concern. We cannot read the future. We are not soothsayers. What we are people who can only rely on information made available to them up to the date of the report. We don't have an obligation to look at things beyond the date of report also. Evaluate the overall presentation structure and content financial statement, including the disclosure and whether the financial statement represent the underlying transaction events in a manner that achieves fair presentation. Then we speak of materiality. Then we tell them that we communicate with those charged with governance. We also provide them that we have complied with ethical requirements. And from the matters with those charged with governance, we determine those matters that are of significant importance and we give our key audit matters. So they have given key audit matters on two matters over here. One is on revenue recognition. So what was that matter and how did they deal with it? And second one is on revenue recognition fixed price contract. So these are their key audit matters which they have evaluated. So this is what is the responsibility which has to be detailed for the audit of standalone financial statements. I hope this answers the query of the girl who asked for the information. So as I said, if we are unable to give a clean opinion, then the only course of action available to us to modify our opinion. So when do we modify our opinion? When we are unable to give a clean or unmodified opinion. So this is the second standard that I'm going to deal with, which is SA 705, modifications to the opinion in the independent auditor's report.
Sir?
Yeah.
One of the student is asking if there is an issue in the going concern aspect of the company, can the auditor issue unmodified opinion?
Yeah. So to give a simple example, no doctor will say the patient is going to die, so please call everybody. He is only going to say that there is seriousness, please call near and dear. Those who have had such situations would know. Doctor will not say he is going to die because anything can change. So supposing there's a going concern issue, but tomorrow I am able to get some investor who puts in money, the going concern may change. So what you're required to mention in the going concern is this, that there is a going concern issue, and if the management has plans to address the going concern issue, whether there are significant uncertainties, then you give what is called a material uncertainty related to going concern paragraph. So that doesn't affect your opinion. But if you do not give the information which is required to let the shareholders know that there's a going concern issue, Then you have to modify the report to state that the information which is required to be mentioned about the going concern risk has not been done, and therefore I'm unable to form an opinion, or therefore my opinion is modified to that extent, qualified to that extent. SA 705 deals with circumstances when the auditor concludes modification to the report is necessary. So, as I said, what are the types of modified opinion? A, qualified opinion, B, adverse opinion, and C, disclaimer opinion. All the three of them are nothing but manner of modification of your opinion. So you no longer give a opinion, you will give a qualified opinion, or you will give an adverse opinion, or you will give a disclaimer opinion. Which one to choose is based on the facts which I will enumerate later. The decision on the type of opinion depends upon the nature of the matter giving rise to the modification. That is, whether the financial statements are materially misstated due to A, inability to obtain sufficient and appropriate audit evidence, or B, auditor's judgment about the pervasiveness of the effects or possible effects of the matter. Now, what is pervasiveness? I'll deal with it later. The auditor shall modify the opinion when he concludes that based on the audit evidence, the financial statement as a whole are not free of material misstatement. In my example, which I gave you, the turnover is 100 crores, profit is 20 crores. There is a mistake of 50,000 rupees. Can we say that there is a material misstatement? No, because based on the materiality calculation, possibly the materiality for a company which is making 20 crores profit would be 1 crore. 50,000 is too immaterial for you to qualify the balance sheet, because the reader will say, अरे ठीक है 50,000 तो 20 crore में 50,000 का क्या value है? So you don't qualify reports for these matters. You qualify reports only when his economic decision making is going to get affected. So his economic decision making will get affected only if the amount which is misstated is so large that his decision making is going to change, or the auditor is unable to obtain sufficient appropriate audit evidence to conclude that the financial statements are free of material misstatement. For example, the stock records are taken away by the income tax department and they have not provided me with any information. The godown is sealed by the income tax department. For whatever reason, there could be some issue. So therefore, when it relates to inventories, you do not have the ability to obtain sufficient appropriate audit evidence. You do not have the stock records. You can't physically verify the godown to see how much inventory is there, because the godown is sealed. So what is my inventory? Management says the inventory is 2 crores. Can you check it? There is no stock record. Management is not doing a fraud. मैनेजमेंट के किसी अकाउंटेंट ने नोट करके रखा है कि मेरा रोज का इन्वेंट्री 2 करोड़ रुपया है, तो जिस दिन इनकम टैक्स का रेड हुआ, they sealed the go down, they took the record, he had a noting that my inventory was 2 crores on that day. But I cannot rely on his noting. I need sufficient appropriate audit evidence, which is stock records, physical verification of inventory, and basis that I will value the inventory. When the stock records are not available, physical verification inventory is not possible, how will I get comfort? How will I get sufficient appropriate audit evidence about the value of inventory? Therefore, I'm unable to obtain sufficient appropriate audit evidence. This is when there's an inability. Now, I have stock records, I have go down, but when I went into the go down, I found that 50% of the material have expired. 50% of material has expired. So therefore, they are not sellable. Nobody can sell material which is expired. They have crossed the expiry date. So, but the management says that नहीं हम ये adjust नहीं करेंगे, हमारा तो खर्चा हुआ है, हम इसको किसी ना किसी तरह बेच देंगे. Now there's a difference of opinion. According to you, since the expiry date is mentioned on the product, no sensible buyer will buy that material. Therefore, the net realizable value of the material is zero. Management is taking a stubborn look because they don't want to book 1 crore loss on account of inventory net realizable value. So, based on your physical evidence, that the inventory of 2 crores is wrong. The inventory is only 1 crore because 1 crore material is gone, is not sellable. Nobody is going to buy. When you go to any shop and you look at the packaging, you see the date of expiry. And then if it is expiry or near expiry, you don't buy it only, right? So it is not sellable. So there you have, based on audit evidence, concluded that the inventory is incorrect, right? So in one case, you have evidence that the inventory is incorrect. In other case, you have evidence. You did not have evidence to know whether inventory is correct or incorrect. This is when the modification needs to be done in your independent auditor's report. So whether you will do a qualified opinion or whether you will do a adverse opinion or whether you will do a disclaimer opinion, the auditor shall express qualified opinion when he is unable to obtain sufficient appropriate audit evidence, but also concludes that possible effects of the misstatement could be material but not pervasive. Now, what is pervasive? I'll take a minute to explain in short. Many times your friend asks you, how are you? You have a headache and your normal answer is, I'm fine, but thoda sar dukh raha hai. Right? This is how you generally respond to a simple question, how's your health? You say, I'm fine, but I have a slight headache. But if you're down with COVID or you're down with fever, you don't say, I'm fine. You say, I'm not fine. Why? Because when you're down with fever or COVID, your entire body is affected. So pervasive is when the misstatement is there across the balance sheet on various aspects of the balance sheet, right? Now, take another example of pervasive. Headache is material, but doesn't affect your other aspects. But if you have a heart trouble, the heart trouble is so large that it's pervasive. So pervasive does not only mean that many items in the balance sheet have to be misstated. It also means that the misstatement is so large that the opinion to say that I'm fine may not be correct. Opinion to say that it shows true and fair view may not be correct. When the value of the misstatement is so large that it affects the reader, then also, although one item is wrongly stated, it can be pervasive. So you will qualify the report when it is material but not pervasive. Or you have information that it is material but not pervasive. For example, in the example that I gave you, I have full records of sales register. My sales have been collected. My purchases of proper books are there. My fixed asset depreciation is okay. My bank statements are okay. My creditors are okay. Everything is okay. Only inventory is wrong.
Sir,
In this situation, yes.
sir, one student is asking, when the misstatement is undetected,
Huh.
so how will the auditor come to know that this misstatement is undetected?
So therefore, your audit procedures should be designed in such a manner that it provides you sufficient appropriate audit evidence to come to a conclusion. And that is the reason why the standard also expects you to take reasonable care to cover, and you are not expected to give absolute assurance, which is why I stated earlier also that absolute assurance is not possible. Reasonable assurance is possible, and reasonable assurance will be achieved if you follow the other standards which talks of sampling, talks of internal control, talks of other evidences, confirmations, all these audit procedures, you don't have to check them 100%. If you have reasonable assurance, if your audit procedures are reasonable to give you a reasonable assurance, errors are possible, which is what in the audit report also says that reasonable assurance is what can be given, absolute assurance cannot be given. Because even is a high level of assurance, but even then something can be missed out. So undetected error, you have to be clear that that undetected happened not because of your gross negligence, but because it somehow went out of your sample. So when is an adverse opinion given? An adverse opinion is given when an auditor concludes that having obtained sufficient appropriate audit evidence, the misstatement individually and in aggregate are both material and pervasive, he will issue an adverse opinion. He will say the balance sheet does not show a true and fair view. He knows fixed asset is wrongly stated. He knows revenue is wrongly stated. He knows, therefore, debtor is wrongly stated. He knows inventory is wrongly stated. So he knows profit is wrongly stated. Multiple items in the balance sheet are wrongly stated. And therefore, he concludes that the misstatement is across the balance sheet. And I cannot say that the balance sheet shows true and fair view. He will say balance sheet does not show true and fair view. You cannot tell your friend, I'm fine, but I've got a headache. I've got ulcers in my stomach. I've got problem in my leg is paining. My hand has got a cut. But you can't say I'm fine. Can you say that? So that's a wrong way of saying. You should say I'm not well. And you have COVID, you have to say I'm not well. So when the misstatement is both material and pervasive across the financial statements, pervasive, it pervades in every aspect of the financial statement, then you will say that the balance sheet and profit and loss account does not show a true and fair view, which is called the adverse opinion. And what is a disclaimer opinion? There are two situations when a disclaimer opinion can be given. In extremely rare circumstances, you have obtained sufficient appropriate audit evidence, but there are multiple uncertainties. And therefore, the auditor is unable to form an opinion due to possible interaction of those uncertainties and their possible cumulative outcomes. He issues a disclaimer opinion. For example, let's take this war situation which is happening in the Gulf. There are multiple items happening. My plant is there in Dubai or Saudi Arabia, and my exports from India are stuck. I know for sure that my customer's plant has been affected in the bombing by one of the countries, one of the parties. And you have evidence to show whatever you needed for 31st March, but there are multiple uncertainties and their possible outcome cannot be known. Can you say it shows a true and fair view? Possibly not. But that's a rare situation. Generally, such situations are rare when you have evidence but still are not able to form an opinion. But it is not impossible. Or when the auditor is unable to obtain sufficient appropriate audit evidence and concludes that the possible effects of undetected misstatements are both material and pervasive. What is the example for this? The accountant made the financial statements. Okay. And he called you for audit. But between the time that you went for audit, the department came and seized all their books and vouchers and everything is gone. Everything is lying with the department. They are not willing to give you a copy of it. You are unable to obtain sufficient appropriate evidence, and therefore you are unable to conclude that the possible effects of undetected misstatement cannot be material and may not be pervasive. Anything can go wrong. So therefore you do not have sufficient appropriate audit evidence to conclude that the misstatement could be material. It could be material because you don't have any evidence to show whether the financial statement made by the company, by the accountant, has any supporting or not, because all supporting, all books have been taken over by the department. Or what you have is only the financial statement printout which he printed and kept with him. Even the data is taken by that department. Computers are seized by the department. So you do not have sufficient appropriate audit evidence. Therefore, you will have to give a disclaimer opinion and giving reasons why you are giving a disclaimer opinion. This is a very important matrix which everyone who's modifying his report must read and tick off to make sure that he chooses the correct modification methodology. 2 columns, nature of matters giving rise to the modification and auditor's judgment about the pervasiveness. Financial statements are materially misstated. You know that they are wrong, but they are material but not pervasive, like the inventory example that I gave. Everything else is correct, only inventory is wrong. So it is material because 1 crore inventory being wrong is material. So you will give a qualified opinion because it is material but not pervasive. The other items of the balance sheet, you have sufficient appropriate audit evidence. The second opinion, you know inventory is wrong, you know depreciation has been wrongly computed, you know sales have been wrongly accounted, therefore debtors are wrong. Because inventory is wrong, profit is wrong. Because depreciation is wrong, profit is wrong. So therefore the misstatement is material and pervasive, which is across various aspects of the balance sheet. You will give an adverse opinion. You will say, does not show a true and fair view. You do not have audit evidence. Same way, you do not have the stock records. So inventory you know is wrong, but everything else you have the record. So you will give a qualified opinion where you'll say on account of inability to obtain details about the inventory, we are qualifying our report. And like the last example I gave you, you have no records with you. So therefore, you know that possible misstatement will be material and pervasive also because every item could be wrong. You will then give a disclaimer opinion. So this matrix is to be ticked off by the auditor in case he is modifying his report to choose the correct method of reporting. Please don't think that मैंने qualified, मैंने कुछ ना कुछ तो कर दिया है. Even a wrong audit opinion can be picked up by the regulator. If you are required to give an adverse opinion, but you give a qualified opinion, you are required to give a disclaimer opinion, but you give a qualified opinion. You are required to give a qualified opinion, but you overqualified and give an adverse opinion. The regulator can haul you up. So choosing the correct modification is also necessary for an auditor to form his opinion. What is material misstatement? A misstatement is the difference between the amount of classification, presentation, disclosure reported in the financial statement and the classification, presentation, disclosure required as per the applicable financial reporting framework. So what is and what should be the difference between both of them is a misstatement. What is and what should be the difference is a misstatement. If what is what should be, then there is no misstatement. And material misstatement is any misstatement which is material to the financial statements in accordance with the materiality criteria in SA 320, materiality in planning and performing an audit. So Institute CAQ, Center of Audit Quality, has come up with a tool to determine materiality. Many of us use the tool. So you use the tool and you determine materiality. As per that materiality, if the misstatement is above that materiality, then it is a material misstatement. For example, if inventory is wrong only by 10,000 rupees, it's misstatement because inventory should be 1 crore 90 lakhs. You have shown it as 2 crores, right? It is misstatement. But is it material? No. So maybe you will not qualify. You'll document it in the list of uncorrected misstatements. And if cumulatively the uncorrected misstatements are material, then you'll again qualify, although individually they may not be material. Why does it happen? It can happen because of appropriateness of selected accounting policy. If selected accounting policy are not consistent with the applicable financial reporting framework, or financial statement including notes thereon do not represent underlying transaction events that achieve fair presentation. The application of selected accounting policy when accounting policy are not applied consistently. I gave you an example. 1 year you're doing WDV depreciation, 1 year you're doing SLM depreciation, next year again you're changing WDV method. So there is no consistency. Therefore, the figures are not comparable, or the method of application is erroneous, or the appropriateness or adequacy of disclosure in financial statement. For example, if a standard or the Schedule 3 requires you to make a disclosure and you do not include the disclosure, then it is a material misstatement, because what is and what should be are incorrect, are not the same. Inability to obtain sufficient appropriate audit evidence. And auditors' inability to, just give me a minute, I'll take some water and come, please. Auditors' inability to obtain sufficient appropriate audit evidence may arise from circumstances beyond the control of the entity, where records have been destroyed by fire or seizure by a government authority. That could be the reason why you did not get audit evidence. Circumstances relating to nature or timing of the auditor's work. For example, when we were doing bank audit during COVID, our appointments came very late. COVID hit in March. Appointments came very late. So there were a lot of items which we could not verify as on 31st March. We couldn't verify the cash as on 31st March. In case of a company, we would not have been able to verify inventory as on 31st March. So the timing of the auditor's appointment was such that you could not appoint, or you could not observe or physical count, or you could not check something. Or the limitation imposed by the management. Management prevents auditors from inventory counting. They say you can't do inventory counting. हम आपको अलाउ नहीं करेंगे. I will not allow you to obtain external confirmation. मैं आपको बैंक बैलेंस confirmation नहीं दूंगा. So these are limitations imposed by the management. So this can also be a reason why the auditor is unable to obtain sufficient appropriate audit evidence. Where the limitation imposed by the management, the auditor shall request the management to remove the limitation. He will say that first, he will not directly say मैं फिर qualify कर दूंगा. He will first tell them that if you do not remove these limitations, I will not be able to complete my audit procedures, and therefore I will not be able to give you a unmodified opinion. So please remove this limitation so that I can give an unmodified opinion. If the management still persists, the auditor shall communicate it to those charged with governance and determine if alternate audit procedures are possible. Now, there's a distinction between management and those charged with governance. Those charged with governance are supreme. They are the board of directors. Management could be the CFO, CEO, or the operating team who have put these restrictions. So you will then mention to the directors that I am not getting this information and they are not giving me access, and therefore I am unable to conclude and complete my audit for process, and therefore I may not be able to give you a unmodified opinion. Where it's a family run company, CEO, CFO are brothers, they are also directors. There they may say there is no distinction between those charged with governance and the management. So nothing happens. He shall resign from the engagement where practical and not prohibited by law. As I said, SEBI, after I think in one of the years, there were multiple resignation when the auditors resigned without giving an audit opinion, although they did 3 quarters work. SEBI changed the law, LODR, to say that if you have given 3 quarters limited review reports, you have to give an opinion, and you cannot say in the 4th quarter that I did not get data and therefore I am not giving an opinion, I am resigning from the work. You give a disclaimer opinion. You give the reason why you are not able to give an opinion. But give an opinion. You can't resign from the engagement. Similarly, Institute also, taking a cue from LODR regulation, also has come up with guidance to say that auditor having accepted an appointment cannot just resign without giving good, valid reasons. Merely saying professional preoccupation is not a good reason. If the resignation is not possible to the stage of the audit, legal or professional restrictions, as I explained to you, the auditor shall give a disclaimer of opinion. If you do not have sufficient appropriate audit evidence, you will give a disclaimer of opinion. Where the auditor decides to resign, he shall first inform those charged with governance regarding the matters about which I did not get information. There could be possible misstatement, and therefore he is resigning. And only then will he resign. So in SA 705 also, there have been revisions. But the only change compared to SA 700 is that the first paragraph where we saw opinion will be called qualified opinion or an adverse opinion or a basis of or a disclaimer opinion. The opinion paragraph will be the first paragraph titled qualified, adverse or disclaimer opinion. And there are no other changes compared to previously. What constitutes misstatement, what situation requires qualification, what situation requires adverse. Those changes have not happened, only the first paragraph. So when a reader looks at the audit report, he will know that it's a qualified opinion. He will know there's a disclaimer opinion, or he will know that's an adverse opinion. He doesn't have to search for what kind of opinion. It is there in the first paragraph of the audit opinion. Before I go to SA 706, I will take you through a sample qualified opinion from the SA 705 appendix, illustrative example. Now, this is an illustration one, qualified opinion due to a material misstatement of financial statement. For the purpose of the illustrative example, it's a complete set of financial statement using fair presentation. Financial prepared by the management. Audit engagement is in description management. Inventories are misstated. As I gave you my example, inventories are misstated. Misstatement is deemed to be material but not pervasive to the financial statements. Therefore, a qualified opinion is appropriate. The relevant ethical requirements that apply to audit are the ICA Code of Ethics. Based on the audit evidence obtained, the audit has concluded that material misstatement does not exist relating to events or conditions that may cast significant doubt on the ability to continue as a going concern. Key audit matters have been communicated. Those responsible for oversight of management differ from those responsible for preparing financial statements. So what will he say? The title is Independent Auditor's Opinion. It is addressed to the members of the company. It's a report on the audit of the financial standalone financial statement. And the first paragraph is qualified opinion. So reading this, you will know it's a qualified opinion. So what does it say? We have audited the standalone financial statement of so and so, so and so, so and so. The first paragraph remains the same because that describes the financial statements. Then this is the opinion paragraph, qualified opinion paragraph. In our opinion, and to the best of our information given, except for the effects of the matter described in the basis for qualified opinion section of our report, the aforesaid financial statement give a true and fair view in conformity with the accounting principle generally accepted in India of the state of affairs, profit or loss, and this thing. Now, what is the basis of a qualified opinion? Now, you have to explain why you qualified. What is the basis? What was the misstatement? The company's inventory are carried in the balance sheet at rupees X. Management has not stated the inventory at lower of cost or net realizable value, but has stated them solely at cost. The example that I gave you, my inventory is 2 crores. 1 crore inventory is destroyed, damaged, or have expired. So therefore, its net realizable value is 0. So what is the value of my inventory at cost and net, or lower of cost and net realizable value is only 1 crore. Management has stated them at cost only, which constitute departure from the accounting standard prescribed under 133 of the Companies Act. The company's record indicated that had management stated the inventory lower of cost, an amount of rupees 1 crore would have been required to be write down. So 1 crore would have come down. Accordingly, cost of sale would have increased by so and so. Income tax, net income, shareholders fund have been reduced by rupees so and so. So we conducted our audit in accordance with standards on auditing, the same language. See the last paragraph. We believe that the audit evidence we have obtained is sufficient appropriate to provide a basis for a qualified opinion. Many people make a mistake of they write qualified opinion here. They write basis for qualified opinion, but here they don't write this word qualified. So therefore, the language reads, we believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. You have qualified, so you must write qualified opinion. Or if you're giving an adverse opinion, you have to write for basis for our adverse opinion. In case of adverse opinion, you will say, we believe the audit have obtained sufficient to provide a basis for our adverse opinion. Where you are disclaimer opinion, you cannot say I have obtained, because you are giving a disclaimer based on inability to obtain. So you will say, we believe that we have not received sufficient appropriate audit evidence to provide a basis for our opinion, and therefore we have given a disclaimer opinion. That's how you will write in this basis for disclaimer opinion, giving the reasons over here why you did not get. So maybe you will write here in my example that the company's books of accounts, other documents, etc., including the data, have been seized by the department, and the company is not able to give access or a copy of the same. And therefore, we have not been able to get any supporting evidence to verify the financial statements. Then you will write, we believe that we have not received sufficient appropriate audit evidence to form a basis for issuance of an opinion, and therefore we disclaim our opinion on these financial statements. That's how you will write the basis for disclaimer opinion. Now, the last section for the day is the SA 706. SA 706 basically deals with emphasis of matter paragraph and other matter paragraph in the independent auditor's report. So what exactly is emphasis of matter paragraph and what exactly is other matter paragraph is what is my objective in trying to explain to you SA 706. There are two types of paragraphs which is the content of SA 706. One is an emphasis of matter paragraph, or in short, it's called EOM. It's a paragraph in the audit report on a matter that is appropriately presented or disclosed in financial statements. So you cannot make an emphasis of matter of something that you believe is not properly stated in the balance sheet. You have to form an opinion. You have to be convinced you should have sufficient appropriate audit evidence that the matter stated in the balance sheet is correct, is not misstated. But you want to invite the attention of the reader to that matter. That's when you make an emphasis of matter paragraph. An emphasis of matter paragraph is not a substitute. Emphasis of matter paragraph is not a substitute for either the auditor expressing a qualified opinion or an adverse opinion or a disclaimer opinion. So therefore, the emphasis of matter paragraph is always placed after the opinion paragraph, because the reader should not feel that this emphasis is biasing the opinion. So you give your opinion, a clean opinion or a qualified opinion. and then you make an emphasis of matter paragraph. Okay. Now, that is the reason why the placement of emphasis of matter paragraph is always after the opinion paragraph, because the reader should not feel by your language that you're kind of conveying a distrust or kind of conveying a what do you say, not sure about your opinion paragraph. That's why you place it after the opinion paragraph, so the reader reads the opinion paragraph without getting biased by what is there in the emphasis of matter paragraph. It is a separate independent paragraph designed to provide additional communication to the user. And what is the other matter paragraph? Is a paragraph in audit report that refers to a matter other than that presented in disclosed financial statement. For example, generally, other matter paragraph is used in maybe in a consolidated financial statement where you say that I've relied on the work of so and so auditors who have done the audit of the subsidiaries, or I've relied on the work of so and so branch auditors who have done the audit of the branches. So it is not a paragraph which relates to something which is stated in the balance sheet. It's a matter of paragraph which you're telling, kind of de-scoping your responsibility over those matters. What is the objective of SA 706? The objective of this standard is that to having formed an opinion on the financial statement to draw users' attention when in the auditor's judgment, it is necessary to do so by way of a clear communication in the audit report. This can be a matter, although appropriately presented, disclosed in financial statement, is of such importance that it is fundamental to users' understanding of the financial statement. This matter deals with drawing of specific reference to matters already disclosed in financial statement. So you cannot make an emphasis of matter paragraph where the matter is not present in the financial statement. So when you make generally an emphasis matter paragraph, you draw attention to a note or information in the financial statement. So you cannot make an emphasis of matter paragraph without drawing attention to a matter which is stated in the financial statements. Or as appropriate, any other matter that is relevant to users' understanding of the audit, auditor's responsibility, or the auditor's report. So here, as I said, you may want to say that I have relied on the branch auditor's report who have audited these 10 branches. So you are kind of telling them about your responsibility and matters which are there in the auditor's report. An emphasis matter paragraph is useful when the auditor, having formed an opinion, intends to draw the attention of the users to a matter, though appropriately presented and disclosed, is of fundamental importance to the users to understand the financial statements. Any other matter relevant to users' understanding of the audit, auditor's report, or auditor's report, where an emphasis matter paragraph is required by any other standard, the disclosure shall be as per this standard only. Such paragraph shall always refer to information presented and disclosed in the financial statement. The auditor should have obtained sufficient appropriate audit evidence that the matter is not materially misstated. So your language cannot be something which gives a doubt to the reader that the auditor actually wants to qualify, but he's making an EOM. So you have to be sure that it matter which is referred to is appropriately stated and you have sufficient appropriate audit evidence for that. An emphasis matter paragraph shall be placed immediately after the opinion paragraph. I explained to you why. Because the reader should not feel that your emphasis matter paragraph is actually a doubt on your opinion paragraph. That's why you place it after the opinion. He reads the opinion without getting the bias of your emphasis matter paragraph. Includes a clear reference to the matter being emphasized and to the relevant disclosure. Indicates that the auditor's opinion is not modified by using words like without qualifying a report, we invite attention note number so and so, or after describing, you can say we invite attention note number so and so, detailing so and so. Our report is not qualified on this account. So this is very important because otherwise the reader will feel that by writing in your emphasis matter paragraph, you're actually displaying a doubt and your opinion is getting qualified. So an emphasis matter paragraph is not a substitute for qualification. It is only an attention inviting note. These lines are necessary to dispel any doubt in the minds of the user that the emphasis matter paragraph is a form of qualification or uncertainty. In case of audit of entity to which SA 701 applies, the above disclosure need not necessarily be a key audit matter requiring disclosure as per 701. The interdependency between SA 701 and SA is explained in a later chapter. So this I will take it on Saturday. The emphasis matter paragraph can also be placed in a qualified opinion as the auditor may want to draw attention to a matter other than the matter covered by the basis of qualified opinion. So there is one basis of qualified opinion and there is another matter which you want to invite attention to the reader. So you can have an emphasis matter paragraph, but an emphasis matter paragraph cannot be on the qualified part, can be only on the unqualified part, because one of the primary requirement of emphasis matter paragraph is that matter which you're drawing attention to, you must have sufficient appropriate audit evidence that is correctly stated. To reiterate, emphasis matter paragraph is not a substitute for a modified opinion in accordance with SA 705 when required by the circumstances of a specific audit engagement. Disclosure financial statement that the applicable financial reporting framework requires management to make or that are otherwise necessary to achieve fair presentation. Reporting in accordance with SA 570 revised, which is going concern, when a material uncertainty exists relating to events or conditions that may cast significant doubt in an entity's ability to continue as a going concern, or for describing a key audit matter. So this is not a substitute for any of these matters. It's a separate attention inviting note. As regards the other matter paragraph definition is a paragraph included in the auditor's report that refers to a matter other than those presented or disclosed in the financial statement that, in the auditor's judgment, is relevant to users' understanding of the audit, the auditor's responsibility, or the auditor's report. What is the objective of both of these? If the auditor considers necessary to communicate a matter other than those disclosed in the financial statement, which is necessary in the auditor's judgment to the user understanding the auditor's responsibility or the auditor's paragraph, he shall include other matters. For example, I explained to you, other matter paragraph can be, I have not audited the 10 branches which are audited by separate branch auditors whose report have been furnished to me. I have not carried out further audit procedures on the same. When an auditor includes an other matter paragraph in the auditor's report, the auditor shall include the paragraph within a separate section titled Other Matters. Where will you place? So see, placement of a particular paragraph is equally important because the reader should not feel that you are casting a doubt on the opinion. So therefore, there's the manner in which everything has to be placed. I will quickly take you back to my earlier slides where I showed you the manner in which the audit report is. There's a flow of audit report is concerned. Please have a look at this. There's a auditor's opinion, basic auditor's opinion. Then after that, you're giving the going concern. Then you're giving the key audit matter. Then you're giving emphasis matter. Then you may give, after emphasis matter, the other matters. So that none of these matters will create a bias when the reader is reading the auditor's opinion. So therefore, placement of the paragraph is very important to dispel doubts in the reader that you yourself are doubting your opinion. When a key audit matter section is present in the auditor's report and other matter paragraph is also considered necessary, the auditor may add further context to the other matters, such as other matter scope of the audit, to differentiate the other matter paragraph from the individual matter described in the key audit matter section. So you may want to write about the scope of the audit. You may write other matter scope of the audit, where you're writing that 10 branches are done by branch auditors whose report has been furnished to you and you're relying on them. When an other matter paragraph is included to draw attention to a matter relating to other reporting responsibility, the paragraph may be titled Report on Other Legal and Regulatory Requirements. For example, all reporting under 143 section are covered under a paragraph called Other Legal and Regulatory Requirements. When relevant to all the auditor's responsibility or user's understanding of the auditor's report, the other matter paragraph may be included as a separate section following the report of the audit of the financial statement, the report on other legal and regulatory framework. So supposing it is only on the auditor's responsibility, so after your legal framework, then you come up with the other matters paragraph. This is generally done in the consolidated financial audit reports. So there has been a revision in SA 706 also. Earlier, going concern was part of SA 706, but now there's a separate paragraph, separate standard SA 570. So any going concern para is separated out and should be titled material uncertainty related going concern. And so there is no other change in the SA 706. The other reporting or emphasis matter, other matter or the other are substantially the same as the previous SA 706, except that there are rules to be followed relating to key audit matters, which is dealt with separately. So I will now take you through what is an emphasis matter paragraph. This is again from the illustration. The audit of a company set of financial statements is done. Terms of engagement, the auditor has given a clean report. Based on the audit evidence obtained, the auditors conclude that a material uncertainty does not exist relating to events or conditions that may cast significant doubt on this thing. Between the date of audit report, the date of there was a fire in the entity's production facility, which was disclosed by the entity as a subsequent event. In the audit judgment, the matter is of such importance that it is fundamental to readers' understanding. Matter did not require significant auditor attention in the audit of the financial statement, therefore it is not covered in the key audit matters. So what are the paragraphs here? Independent auditor's report addressed to the members of the company. Title of the report is Report on the Audit of Standalone Financial Report. It's a clean report, so there is no change in these two paragraphs. Basis of opinion also remains the same. Here you have a emphasis of matter. We draw attention to note number X. So that balance sheet should carry the note describing what has happened, which describes the effects of the fire in the company production facility. Our opinion is not. So this happened. See, if this happened before the year, you would have booked the loss. So there was no need to do an emphasis matter. This happened after the year. So your balance sheet as on 31st March 2025 was correct. Subsequently, there was a fire which has affected your PPE, inventory, etc. And the management has disclosed the impact and the insurance coverage and loss, etc. in that note. So your opinion for 31st March 25 is not affected because the event has happened after 31st March 25. And it is not an event which is throwing more light on a situation as on 31st March 25. The fire itself happened after 31st March 25. So therefore, you will make an emphasis of matter. Then you do the key audit matter. Then you do the other audit matter. The financial statements of ABC company for the year ended so-and-so were audited by another auditor who expressed an unmodified opinion on those statements on so-and-so. So this will also be there. For example, this is very important, and NFRA and regulators have picked this up regularly, that when you're appointed for the first time, the comparative figures which you are giving your opinion on have not been audited by you. You must tell the reader of the financial report that you have not audited the comparative figure. You're relying on the report of another person. So that will come in other matter paragraph like this. The financial statement of the company for the year ended 31st March 20x0. This is 20x1, right? So X0, the previous comparative, were audited by another auditor who expressed an unmodified opinion. So generally, we also mention was audited by another was audited by the predecessor auditor, Messrs. XYZ, who expressed an unmodified opinion on those statements on 31st March 20x0. Why the report dated so and so. I will also mention the report date, and I will also mention the name of the auditor when I give the other matters paragraph. Generally, I do that. Responsibility of the management remains the same. Auditor's responsibility remains the same. And other legal and regulatory requirement remains the same. So all this is part of the SA 700. So these paragraphs are same. So you will get it from the illustration 1. This also you'll get in the illustration 1. And this is also you'll get in the illustration 1. Most of us use the same language unless there is any tweaking required to suit your circumstances. Now I will take you through a few case studies that I've prepared, and I will explain to you why and how the modification will take place. These case studies have been prepared from actual regulatory reporting. Okay. Case study 1. During the audit of Aram Limited, an auditor finds a number of processing errors for sales. The total error has resulted in overstatement to sales and account receivable of rupees 100 lakhs. Discussion with management indicate the problem was the result of staff leave and some confusion regarding processing of routine sales. The process has now been amended to ensure the error does not occur again. As it is late in the audit, the client has refused to adjust the financial report for the error. Net assets of Aram are 500 lakhs and the reporting and the operating profit has been reported at 125 lakhs. How should the auditor address the issue when forming an opinion for Aram? So this is the thing. So just one. So please read this as net sales of Aram. So factually, there's an error of 100 lakhs. Net sales of Aram are 500 lakh, which is reported in the financial statement. The operating profit is 125 lakhs, right? So roughly the profit percentage on sales is 25%. The profit percentage is 25%. So on 100 lakhs, the profit is overstated by 25 lakhs because the percentage is 25%. So 25 lakhs divided by is almost 20% profit overstated, which is way above the materiality. So how will you do and what is the answer to this case study? Had it been so SA 450, evaluation of misstatement identified during the audit, is the base which helps the auditor to form an opinion on the financial statement as per 700 to conclude whether reasonable assurance has been obtained about whether the financial statement as a whole are free from material misstatement. SA 450 also gives reference to SA 320, materiality in planning and performing audit, which states that in each individual misstatement is considered to evaluate its effect on the relevant class of transaction, account balancer, disclosure, including whether materiality level for that particular class, account balance disclosure, if any, has been exceeded. In the given case, the error has been identified by auditor, which has resulted in overstatement of sales and account receivable. The same is misstatement as per paragraph A1 of 450. So it is clearly a misstatement, right? The same is communicated to management. Management evaluated the error and provided their explanation. However, management also amended the process to ensure accurate records and risk of material misstatement in future financial statements. As the operating profit is directly linked with sales, the misstatement is material to its relevant class of transactions, which may have an impact on the auditor's opinion in financial statements. As per SA 260, paragraph 424, the auditor should communicate with those charged with governance when he expects to modify the opinion. Even after communication, the financials are not adjusted. The auditor, from the fact that the profit is overstated by 25 lakhs, material operating margin is 25% of sale was 500, my operating profit is 125. And since my sale is overstated by 100, my profit is overstated by 25 lakhs, which is almost 20% of the total operating profit. Even the account receivable is materially misstated, right? Therefore, you will need to qualify your opinion, where you will mention in the basis for qualified opinion, the company's sales and account receivable carried in the financial at rupees dash and dash respectively as at 31st March 2020 are overvalued by 100 lakhs due to processing errors for routine sales. The management has not corrected the said error, and had management corrected the misstatement, the sales of rupees 100 lakhs and consequently profit before tax would have been lower by rupees 25 lakhs. Sale would have been lower by 100 lakhs and consequently profit before tax would have been lower by 25 lakhs. So this is how you will qualify your opinion. So this is the material misstatement. It is only affecting sales and profit. It is not pervasive, because when sale is affected, account receivable is affected. It is a contra, and profit is affected. So therefore, you will qualify the opinion by saying the sales and so is higher by rupees so and so. Management has not corrected the said error, and had management corrected the misstatement, the sales of rupees 100 lakh would have been corrected, and consequently profit before tax would have been lower by rupees 25 lakhs. So this is how you will qualify the report in this case. In the next one, an auditor is involved in the audit of Masedar Limited. A number of disagreements occurred during the audit concerning valuation of the company's asset. These disagreements remain unresolved at the time of forming the auditor's opinion. In the opinion of the auditor, the assets are overvalued by 100 lakhs. If the assets were revalued, rupees 50 lakh would be offset against balances in the asset revaluation surplus, and the remaining decrement would be recorded as a loss in revaluation. Net assets of Masedar are 500 lakhs and profit is currently 100 lakhs. Depreciation rate on the said class is 15% SLM method. How should the auditor address the issue when forming their opinion for Masedar Limited? So there are multiple items in this which are affected in the balance sheet. It is not just sales and profit. My depreciation is wrong, my profit is wrong, my fixed asset is wrong, my revaluation surplus is wrong. So as per SA 700, requires the auditor to form an opinion to conclude as to whether the reasonable assurance has been obtained about whether the financial statement as a whole are free from material misstatement. This conclusion takes into effect the auditor's evaluation of uncorrected misstatement, if any, on the financial statement in accordance with SA 450. The auditors identified material misstatement, the carrying value of assets, consequent impact on the several items of the financial statement. The effects of these misstatements are both material and pervasive to the financial statement. As I said, your inventory is affected, revaluation reserve is affected, surplus is affected, PP is affected, depreciation is affected. These misstatements are not addressed by the management. The financial statement continue to be misstated, which is not only material but also pervasive. Therefore, the auditor has to give an adverse opinion in accordance with SA 705. Why will he give an adverse opinion? Because he knows that these all items are wrongly stated, and therefore the asset does not show a true and fair view. As I said, you cannot tell your friend that I'm fine, but I have a headache, I have stomach ulcer, I have ulcers in my leg, I have a fracture in my right leg, I have got my hand is sprained. You cannot say I'm fine after that, right? So therefore, you will say that balance sheet does not show a true and fair view, and then the basis for adverse opinion, you will say the PP is overvalued by 100 lakhs. This overvaluation needs to be offset against the revaluation surplus of 50 lakhs, and the balance chart shows statement of profit and loss account. Management is not given effect to this. Therefore, the PP is overstated by 100, revaluation surplus is overstated by 50, profit is understated by 35 lakhs, depreciation is overstated by 15 lakhs. Since these impacts are pervasive in nature, the financial statement do not reflect a true and fair view of the statement of affairs and of the balance sheet as a so and so, profit and loss so and so. This is your basis for adverse opinion. Case study number 3, Messrs. Reliable Industries Limited had an upward trend in profitability for last couple of years. The current PBT was, however, much lower than the last 2 years. The auditor had determined the materiality based on the PBT of last year when commencing the audit for the planning purposes. So it's an annual audit. So for planning purposes, मैंने last year का profitability लेके मैंने मेरा materiality compute किया. Materiality was set at 100 lakhs for the planning purposes. The profit for the year was lower by 25% as compared to the previous year. There was a misstatement aggregating to 90 lakhs during the year, which remained uncorrected while issuing the report. materiality that I set up was 100 lakh based on for planning purposes, but profit is lower by 25 lakhs as compared to the previous year. Therefore, technically, when I am reporting for the current year, I will have to take into consideration the current profit, which is 75 lakhs now, right? Which is lower by 25%. So materiality also will come down by 25%. Against a materiality of 75, my misstatement is 90. Therefore, the misstatement is material when compared to the current year's financial statement. So your misstatement materiality is determined at two times. One is when you do planning. When you do planning, possibly the financial statement for the year is not prepared. You go on the basis of last year's financial statement. If there is substantial change between last year's profit and turnover and current year's profit and turnover, you have to revise the materiality so that you will evaluate the misstatement with reference to the final financial statement for the year, which is the case over here. So the answer to this case study is, as part of the planning for the auditor determined materiality based on last year's profit before tax. Actual PBT for the year was significantly lower by 25%. The auditor needs to revise overall materiality and performance materiality based on actual PBT of current year in accordance with paragraph 10 of SA 450. It is important to note the auditor expresses opinion on the financial of a particular year and not on the last year's position based on financials of the last year. Therefore, final evaluation of uncorrected mistake and sufficiency audit work must be evaluated with reference to the actual financials of the current financial year. The auditor should be alert throughout the period for any possibility of the actual financial result being significantly different, which in this case has been the case from the estimates made during the planning process. And therefore, he needs to revise the materiality threshold and the extent of audit test. Therefore, on the basis of revised profitability, which is lower by 25%, the materiality ought to have been lowered to 75 lakhs. Since the misstatement is more than the revised materiality, the auditor would be required to modify the opinion by qualifying to it, assuming that the misstatement is not pervasive. So, you cannot just blindly take last year's materiality and apply it to the current year. You will have to make sure that the materiality is revisited when the financial statement for the current year is completed. Once the financial statement for the current year is completed, then you will revisit the materiality and evaluate the cumulative misstatement with the materiality based on the final financial statement for the current year, because the misstatement is in current financial year and it is material compared to the figures of the current financial year and not the previous financial year. This is my last case study. Company H has prepared its consolidated financial statement for the year ended 31st March 20XX. While preparing CFS, the recoverability plan towards its exposure in the form of loans and advances investments in some of the subsidiary and step-down subsidiaries were not given to the auditor. The exposure of the said subsidiary and step-down subsidiary is 75% of the total asset and 42% of the net worth of its consolidated financial statement. The auditors of the said company have issued qualified report on these consolidated financial statements, reasoning their inability to obtain to comment upon the adjustment with the assumption that the impact on material statement is material. Do you agree with the position taken by the auditor, or you would like to take a different position? So what has happened? Loans, investment in shares, corporate guarantees, etc. of some of the subsidiary and step-down subsidiaries are given to the auditor. The exposure of the said subsidiaries is 70% of the total asset and 40% net worth. So they have qualified the report. Now, whether it is correct or not correct is what we are going to conclude on the basis of this case study. If you remember, I had told you pervasive has two meanings. One, when it is pervading the entire financial asset. And the second one is when the item is so large in itself that it affects the true and fair view of the balance sheet as a whole. In this case, since the exposure of the subsidiary is 75% of the total assets, over which I do not have sufficient audit evidence, it is pervasive, and therefore the auditor giving a qualified opinion is incorrect. The firm X with the qualified opinion of H Limited for the year 31st 20XX due to inability to comment upon adjustment, if any, that may be required. Financial exposure in the form of loan investment, carrying value of investment account was 75% of the total balance sheet size. Therefore, the impact of potential adjustment was material and pervasive. However, the EP erroneously considered the impact as material instead of considering it as material and pervasive, which would have warranted an adverse or disclaimer opinion. From the case study, it is evident the information of recoverability was not provided by the management. Therefore, the auditor does not have sufficient appropriate audit evidence to conclude the correctness or otherwise of the recoverability of the exposure amounting to 75% of the balance sheet size. It is evident that the possible effect of misstatement were not only confined to investment, also having impact on the other account like balances, loans, advances, impairment, provision, etc. SA 705 requires that when the cumulative effect of possible misstatement is material and pervasive, the auditor must disclaim its opinion in his audit report. Therefore, the auditor needs to issue disclaimer opinion stating in his disclaimer opinion paragraph, basically that the fact that sufficient appropriate evidence was not available for in respect of recoverability of exposure of the company, and therefore the auditor is unable to express an opinion. So instead of qualifying it, he should have done a disclaimer opinion. So what I said, this is again picked up by the regulator. Merely because you are modifying your report is not adequate. You must modify it correctly. It is important that you modify the report correctly and you do not just blindly pick up anything that you want. Client says, ठीक है आप qualify करो, आप disclaim मत करो. You cannot go by that. You have to do what is required as per the standard SA 705. Thank you. So if there are any further questions, I'll be happy to answer. And on 14th, I will be taking SA 701, a couple of one or two more case studies on on the entire 700 series. And also I'll be taking you through Caro 2020 and what were the new clauses, what are the changes as compared to the earlier Caros. Many of you being students, you must know how the history of Caro has happened. So I'll take you through the reporting requirements of Caro.
Students, you may ask your query. If you have any doubt, you can ask in the chat.
Sir, can you take one more case study? 15 minutes are there, sir.
Okay, just give me 2 minutes. I'll just prepare one
Or
more
you can revise, sir.
Yeah, just give me 2 minutes. I'll take one more case study.
Okay, sir.
Yeah. So this is a case study. Perfect Trading Limited, a company engaged in trading of commodities, prepared its financial statement for year ended 31st March 20XX. While preparing the financial statement, the chief accountant did not include the following disclosures: details of submission of stock statement and trade receivable to bankers against working capital loan of 25 crores. Actually, this case study will be relevant after I speak to them about Caro. Just a minute. Just a minute.
No problem, sir. You can revise the entire content which you because आपने सर बहुत अच्छे concepts सर स्टूडेंट्स को समझाए हैं सर. तो स्टूडेंट्स इंटरमीडिएट फाइनल दोनों के होते हैं ना सर, तो अगर आप रिवाइज भी कराओगे 10 मिनट तो स्टूडेंट्स को अच्छा लगेगा.
Okay, I'll go to my presentation again.
सर कुछ चीजें थी जैसे परवेसिव क्या होता है,
Yeah.
और तो इंटरमीडिएट के स्टूडेंट्स को सर कंसेप्ट्स बहुत ज्यादा नहीं, तो कंसेप्चुअल जो चीजें हैं सर वो आप एक बार
Sure.
रिवाइज करा सकते हैं सर.
ठीक है. So let me also give you another example of how to deal with 706 and 705. Okay. And I'll give you with an example which you will understand quickly. Assuming that I am a heart patient. Okay. I've had a bypass, right? My reports, my blood reports are correct. My blood reports are correct at this juncture. So when my doctor gives his report, he will mention that I invite attention to the fact that Mr. Jendran is a heart patient who went through bypass. Why? So this is an emphasis of matter. My reports are correct at this juncture. Supposing my cholesterol is to be checked or my X parameter is to be checked, all those parameters today is correct. But the reader should know that I have a history of bypass and I had some problem, and that is an emphasis of matter. So he's inviting attention to the fact that I've had a bypass. So that's how an emphasis of matter is there. Now let's assume that my cholesterol or the parameter which is required is outside the normal. He cannot say that I'm fine and make an emphasis of matter to say that Mr. Jendran was a heart patient. Because if he does that, what will happen is this, that he should have qualified that his parameter is not proper. Instead of that, he is making an emphasis of matter. An emphasis of matter necessitates that the information should be correct. So in my case, the blood report should be correct. Blood report is not correct. But he's trying to circumvent that by bringing an emphasis of matter. Therefore, in my presentation, I told you that emphasis of matter is not a substitute for qualification. He should have qualified my health to say that his blood reports are not correct. Many a time we tend to say that ठीक है आप qualification लेने को तैयार नहीं है, मैं EOM करता हूँ. That's a wrong method to take, because an emphasis of matter necessitates that what is stated in the financial statement is correct. So in my example, if my blood report is proper and he invites attention to the fact that I was a heart patient in the past, that's an emphasis of matter. But if my blood report is not correct and he only invites attention to the past that I was a heart patient, that is a wrong reporting, because he should have said my blood reports are not correct instead of just inviting attention to the fact that I was a heart patient in the past. So this distinction is important, that the emphasis of matter paragraph is only required when you think that a reader. So today my blood report is okay, but tomorrow it may not be okay. So he's inviting attention to the fact that I was a heart patient in the past. But if my report is not correct today, he cannot circumvent that by saying that he's a heart patient in the past. He needs to say that today my blood report is not correct. So this distinction, you have to make sure that emphasis of matter is not a substitute for qualification. Emphasis of matter is nothing but an attention inviting note where the auditor feels that a reader should know this fact. Why understanding my opinion. Okay, so therefore, an emphasis on matter paragraph is not a substitute for qualification. Same way I told you about pervasive, you have to be very clear about pervasive. Pervasive is when it pervades, right? Multiple items in a balance sheet are wrongly misstated. Therefore, you cannot say it shows a true and fair view, but inventory is wrong, PP is wrong, debtor is wrong, sale is wrong, profit is wrong. What is right? You're supposed to say it does not show a true and fair view. I said, you cannot say that I'm fine, but I have a headache, I have ulcers, I have fracture in the leg, my hand has got cuts, my hand has a sprain. You are not well. You say I'm not well. Don't say I'm well, but these are my problems. So qualification is only when it is not pervasive. Adverse is when it is pervasive, when it is there across various elements of the balance sheet. Same way, a headache is not equivalent to a heart trouble, right? A headache is a small item, it is material, but a heart trouble is a large problem. So therefore, you cannot say that he's fine, but he has a heart trouble. You have to say he's not fine. So pervasive will also include those items which are individually so material that they vitiate the true and fair view of the balance sheet. Therefore, they are pervasive. So you have to be very clear that pervasive does not mean, for example, in our example, which I gave you a case study, 75% of my investment does not have proper supporting in my consolidated financial statement. Although it's only investment, but 75% of the asset side is wrongly, I don't have information. Therefore, I have to give a disclaimer opinion because it is not only material, it is pervasive, although it is only one item. So this is where you need to make a distinction between pervasive, material, when to qualify. The regulator is not happy only with your modification to the report. He wants you to correctly modify the report, whether it is NFRA or the Institute Disciplinary Committee. You have to correctly modify the report. You have to give the correct report. And that is why you have SS 700, 705, 706. And these are all our boilerplate reports to make sure that you report in the proper framework so that the reader understands how the report is to be read. If each of us was to draft a report in our own manner, Mr. Rajesh Sachdeva will write the opinion in the third page. Madam will write the opinion in the second page. I will write the opinion in the first page. A reader will not know where to look for the opinion. That is why you need a framework, you need a proper format, a boilerplate, so that the reader knows where to look for the relevant things.
You have explained very nicely, and rather you have linked it with our physical structure also, which the students can correlate actually. So they will always remember that how like they can interlink emphasis of matter paragraph with heart disease or blood report and materiality and pervasiveness, like our whole body, right? Sir, one of the student is asking about other matter paragraph also, if you can just simplify that.
Yeah, so other matter paragraph is where you want to describe something to do with your audit responsibility, auditor's responsibility. Generally, other matter paragraph is when you are doing a scope exception or you're saying something about your audit process, audit responsibility. Typically, as I said, that it is used in 3-4 instances. One, you have been appointed in the current year. Previous year, Mr. Rajiv was the auditor. So when you are giving an opinion on the current year's financial statements, last year's financial statements, you have not done the audit. You are relying on his work. So in the other matter paragraph, you will mention that the comparative figures for the previous year are audited by the predecessor auditor, Mr. So-and-so, who has issued an unmodified opinion why it is report dated so-and-so. So you are giving a scope exception that मैंने वो किया नहीं है, मैंने इनके रिपोर्ट पे रिलाई किया है. सेम वे जब आप कंसोलिडेटेड फाइनेंशियल स्टेटमेंट करते हैं, आप होल्डिंग कंपनी के ऑडिटर हो और 10 सब्सिडरीज हैं, इनमें से 4 मिस्टर राजीव ने किया है, 4 मैडम ने किया है और 2 अनऑडिटेड हैं, मैनेजमेंट ने बताया छोटे से हैं वो. सो यू विल राइट इन योर अदर मैटर पैराग्राफ द कंसोलिडेटेड फाइनेंशियल स्टेटमेंट इंक्लूड्स financial statements of 8 subsidiaries which are audited by the respective auditors, whose report have been furnished to us, and the balance sheet size you will mention कि उनका size क्या है, कि their respective balance sheets show asset of so much, turnover of so much, profit of so much. And 2 balance sheets are prepared by the management, are management certified, which are not material, and therefore our report is not qualified on that account. So where a component is material and it is not audited, there's an announcement that you have to qualify the report, because you are assuming the figures to be correct, but actually they are not correct. So you have to qualify that unaudited numbers have been taken. Another place where you could do other matters is that, for example, you have been appointed after 31st March to do an audit. So you did not inventory count, but you did alternate procedures. So you can say that our appointment happened after 31st March. Therefore, we could not physically verify the inventory. However, we have carried out alternate procedures to make sure that inventory stated as on 31st March are fairly represented. So these are other matters, because a reader should know that you did not do this, but you did something else, because your appointment itself happened after that. Especially this happened during COVID. During COVID, we couldn't visit and see those inventory. Nobody did stock taking during that period. But that doesn't mean that you qualified your inventory. You did other procedures. When you could go, you went and saw, and then you rolled back the figures back to 31st March. So that is how you conclude. And that is why for COVID years, the due dates were all extended to November, December, January. In fact, the tax audit dates were extended, ROC dates were extended, because you did not have time to complete your procedures. So you did when you could, and you rolled back the numbers back to 31st March. That can be covered in other matters, because that is a kind of telling you about your responsibility and your audit process.
Wonderfully, sir, you have make the students, and in fact, rather, I would say for myself also, I was able to correlate that you have made us understand with the help of so many easy examples that yes, student can. Like they can, if they remember those examples, they will definitely be able to write in the examination. And I would say that on other matter paragraph, the example which you have given, subsidiary and parent company, it's being asked in the final examination, it's being asked in the IBS integrated business solutions paper. It is very, very important, but students are not able to correlate and they are not able to write in the examination. Dear students, you have seen that this topic, audit report, is hard, right? Because ultimately,
It is what we are appointed for. We are appointed to issue audit reports, not to make
audit report
statements.
And not only from the perspective of
ये 5 पेज के लिए मिलता है.
बिल्कुल बिल्कुल and for auditor
अच्छे बनाने में नहीं मिलता है.
Auditor को तो उसके लिए है, and for other stakeholders.
Yeah.
Either you are investor, you will look for the audit report कि कैसा है, उसके अंदर क्या उसके बारे में है. So it is very important topic, and dear students, I request you all to please now read the SS 700, 705 and 706, and now you will be able to correlate the terminology and how to express the opinion and see the report like sir has shown. So definitely you can do wonders, and when you're analyzing, when you're reading the audit report, then also you'll be able to interlink, and when in examination also you will be able to do an as a practical audit insight also. It will be great for you. One of the student is writing, thank you so much for increasing our practical knowledge as well as theory, because generally we observe that in auditing subject results were not good. But nowadays, students are performing well because of this practical audit insights. They are able to correlate the theoretical concept with practical knowledge. So they are definitely able to write in the examination also. We really thank you. Thank you very much, sir, for sharing your knowledge.
Knowledge shared is knowledge multiplied.
Definitely, sir. And dear students, we are having another session for 701 and CARO reporting on 14th March, right? So looking forward to see you all. And on Saturday, we will be again meeting you at 4 p.m. But till the time, your homework is to revise SS 700, 705 and 6. And if you can read 701 and CARO, that will definitely help you, right? So this is your homework. And one more thing, your feedback is very, very important for us. So do share your feedback so that we can work on the same further, right? And thank you very much, sir. Thanks a lot for sharing your knowledge and your practical experience and correlating with the like normal examples, which anyone can correlate. Those who are not CA students, they can also correlate. So these are really very good examples. Over to you, sir. Sir, you want to say something?
Yes.
Yeah.
Even सर हमारी नॉलेज भी बहुत शार्प हुई है सर आप आपका लेक्चर सुन के तो थैंक यू वेरी मच सर दैट्स a great experience sir.
Thank you,
It
sir.
is rather pleasure listening you sir.
Thank you, sir.
बहुत
Thank
अच्छा
you.
लगा सर बहुत मजा
Thank
आया
you.
आपका लेक्चर
Thank
सुन के
you.
सर
Thank you.
रियली
Thank you, sir. Looking forward to see you on 14th March.
Yeah,
Yeah.
sure. Thank you.
Thank you.
Thank you,
Thank
sir.
you, dear students. Thank you, technical team.
Thank you.
Thank you. Anji.